VA assumable loans, why it might not be the best fit for you, but I do have two other things you may have not thought of that will give you similar results. Stick around to get all the details. See you on the other side. What's going on, guys? In this video, we are going to cover a lot of information, but more importantly, we're going to cover VA assumable loans, the pros and cons of them, and if that doesn't fit your financial wants and needs, we do have two other products that could give you similar results. Now, before we jump into that, let me quickly introduce myself. My name is Patrick Longley. I'm a licensed real estate agent out here in Hawaii and have been for nearly a decade, helping buyers, sellers, investors, and service members like yourself with their real estate needs. With that being said, if you have any questions or if you want to get your hands on a custom list, which I can build for you, finding you homes that actually allow for VA assumable and get you information like what the current interest rate is, what the monthly payment is, based on location, bedroom and bathroom count, and properties that are currently on the market. If you want all that information, give me a holler. I got my contact information right here, or you can directly DM me on any of my social media platforms to get that custom list. Now, with that being said, we are going to cover a lot of information. So let's first start off with VA assumable loans, what it is and what are the pros and cons. So a VA assumable loan is basically when one buyer ends up assuming the seller's loan. So in a general situation, let's say that a seller bought a property for $700,000 with the VA loan with a killer interest rate back in the day of 3%. So they have a very low monthly payment, about $3,500 a month for a $700,000 loan with zero down and a 3% interest rate. So that is the seller, that is the loan that they have in place. What an assumable loan is when a buyer comes in and basically takes over their loan and takes over those payments. So they would be able to purchase the property and have that monthly payment of $3,500 with that 3% interest rate. So in theory, that is what a VA assumable loan is, but there's a lot more we need to dive into. So let's go over the pros and cons and how it works. So pro number one is the obvious one. You could potentially get yourself into a property and have an interest rate of 2.5% to 3.5%, which we might not see for a very long time when every other Joe Schmo out there is using a VA loan and getting rates at about 6.5% currently here in 2024, which can drastically change the monthly payment. Just to give you a scenario, if you were to get a 3% interest rate and a 6% interest rate on a $700,000 loan, that monthly payment would be a difference of $3,500 a month for a 3% interest rate on a $700,000 loan, compared to a 6% interest rate on a $700,000 loan being almost $4,800. And that's a savings of $8,400 a year. That's a chunk of change. So you can see that the interest rate can really affect what your monthly payment is and how much money you have to actually come out of pocket every single month to cover that payment. So the first huge pro of the assumable loan is being able to have that lower monthly payment. Now let's get into the cons, because there are a few cons you need to be aware of and a lot of things that people are not aware of. The first con is the amount of time. Now, the amount of time that it takes to close on a VA loan is generally anywhere between 3 and 8 months, but usually it's between 3 to 6 months, where a normal transaction, if you were to get a new VA loan or new conventional loan, can generally take 30 to 45 days. Now, this can pose as a challenge for a buyer if they are in a unique situation. Let's say they PCS out here, they have 60 days of TLA and they're in a hotel, but they need to move into a property within 60 days. Now, that would be a bit of a challenge because we know that VA assumables generally take 3 to 8 months, 3 to 6 months. So they would have to find a month-to-month place to pay for while they're waiting for that VA assumable to close. Now, this usually leads people to ask, well, why does it take so long for a VA assumable to close? I'm just simply taking over somebody else's payment. Well, what you have to keep in mind is that they generally have maybe 1 or 2 people in the assumable department because the lenders are not making much money on this deal. So they basically have 1 to 2 actual lenders in the assumable department for Hawaii covering any and all assumable purchases and loans on the entire island. So they are massively backlogged and they generally are very difficult to get a hold of. So it's important that you understand that timing because that can be a huge con for a lot of families looking to utilize an assumable loan. Con number 2 is the cash gap. This is gonna be the biggest objection and biggest thing that's usually gonna stop people in their tracks when they're going down the assumable loan rabbit hole. Now, what do I mean by a cash gap? Let's utilize that same scenario before where we have a seller who has a loan with an outstanding balance of $700,000 with a 3% interest rate and a buyer who wants to purchase that property and take over that loan. Well, If that seller is going to sell their property, they're most likely going to sell it for more than they actually bought it for. So let's say they listed for $800,000, they have a loan of $700,000. There's a $100,000 cash gap that needs to be covered by the buyer. That's correct. It's going to cost you $100,000 in that unique scenario to actually assume that loan. That's $100,000 you need to come out of pocket to essentially assume that loan and get that 3% interest rate. And this is where a lot of people get stopped in their tracks and basically say, well, I don't have $100,000. What other options do I have when it comes to getting a lower interest rate like that 3% with the Assumable? Well, this, my friend, is where the two other options come in, where we can get you similar results at a much lower cost. So what other options do we have when it comes to lowering our interest rate and getting similar results that we would get with the Assumable, but with less cash out of pocket? Well, that's what we're gonna cover right now. Option number one is to do a fixed buy down. What a fixed buy down is when you essentially pay the lender and they will buy down your rate. So if you have an interest rate of 6%, you can actually give them money to make your rate 5% or 4%. Now, the general cost to do this can fluctuate, but on average, you're looking at 1% of the loan amount will give you a quarter point. Let me repeat that. 1% of the loan amount will give you a quarter point. So utilizing that $700,000, if we were to multiply that by 1%, that gives us $7,000 to bring it down a quarter point to 5.75. Now, if we wanted to bring it down all the way to 5%, we would just multiply that number, 7,000 times 4, because we have 4 quarters, that makes an entire point. And that would be a cost of $28,000. And if you wanted to go down 2 points, we'd multiply that by 8, and that would give us a cost of $56,000. Now that gives us a lot closer to that interest rate that the Assumable loan had at a much cheaper cost to get in. But you then have to ask yourself, how long am I gonna hold on to this property, and what is the break-even point? What is the savings I'm getting every single month, every single year? And what do I have to pay to get those savings, and how long am I gonna hold on to it so that I can recoup that investment of getting that lower monthly payment? And this is something that we generally like to talk to our clients about, whether they talk to me directly or talk to the lender, to kind of see which scenario would be better. Would it be better to go the Assumable route or to do a fixed buy down? Now, on fixed buy downs, they do have thresholds on how low they will actually go. Generally, they won't go as low as 2% or 3%, but it is something you might want to explore and kind of compare side by side on how much cash do I have to bring to the table to get my rate at where I want, and more importantly, how long am I going to hold on to the property to make sure that that cash that I'm investing into getting a lower rate makes sense. And that is a huge, huge part to this. Okay, now the second option, and my preferred option in this current market, and I'll explain why, especially if you are a veteran, because there's a combination of things you can utilize, is the 2-in-1 buy down. Now, how the 2-in-1 buy down works is similar to the fixed buy down. Is we are going to buy down the rate, but we're actually going to have the seller pay for it. Now, there's a bunch of different ways on how we can negotiate the seller to pay for it, but we're not going to cover that. We're just going to understand the concepts. And if you have any other questions on how we do this, because I do it with a lot of my clients, feel free to reach out to me. Got my contact information right here. So how it works is essentially we would negotiate getting money from the seller. Let's once again say that the 2-in-1 buy down costs 25 grand, and we would take that money and give it to the lender. The lender would then say, okay, I have the 25 grand, and that's how much the 2-in-1 buy down costs. And now your interest rate the first year is going to be 4%. The second year, it's going to be 5%. And the third year, it would go back to the initial rate that we had, which is 6%. Now, why would anybody do this? Well, the reason why is a couple scenarios. Number one, it allows you to have a low monthly payment for the first 2 years and give you time and runway to A, wait for promotions or savings so that you can afford more every single year. And 2, it allows you to potentially refinance before you even get to that third year, but give you time along the way to have a lower monthly payment. And you can use this amazing product called the IRL, the Interest Rate Refinance Reduction Loan, specific for veterans. We're at a very low cost where you can refinance out of that loan and lock in a low interest rate, which is what I'm suggesting for a lot of my clients, because we are seeing that rates are trending downwards. So if you can have a low rate now and wait for rates to catch up at that low rate that you're at. You can refinance and lock it in. Now, these are some general concepts. I have a playlist right here that kind of dives deeper into assumable loans, interest rates, as well as the EARL and 2-in-1 buy down. So if you want to dive deeper into that, check out these videos right here. But if you want to connect with me and either A, get your hands on one of these assumable loan lists, or B, talk about whether an assumable loan is a good route for you, or whether it'd be better to maybe explore using a fixed or 2-in-1 buy down to get the rate that you want, I'm here to give you some guidance as well as help you. So feel free to reach out to me. I got my contact information right here, or you can directly DM me on any of my social media platforms. And lastly, if you got any value out of this content, if you guys could do me a huge favor, smash the like button as well as click the subscribe and notification bell so you get notified whenever I drop videos just like this. With that being said, I'm Patrick with PatrickLongleyRealty.com, powered by eXp Realty. Hope you have a beautiful day. I'll talk to you soon. Aloha.